it is an economic outlook, and I certainly won't entertain you with forecast numbers, but I will do a bit of global macro. It's very global, not very detailed. We can talk more detail if you want, but focus more on what central banks can and cannot do in the spirit of talking about stuff that's important, and then turn and apply that to the situation in Europe. I think it's appropriate to talk about central banks on the day where, as we talked about before, Governor Carney, Bank of Canada, to be governor of the Bank of England, entertained the Treasury Committee on that topic for 4 hours. I'll only do 15 minutes, but cover much of the same ground. So to sort of put myself in your mind in terms of my outlook, here's our forecast. Here's a history and a forecast for industrialized countries, where I've dotted on a random trend line, that's the dotted line, and put up 4 countries, the US, the euro area on the left-hand side, Canada, and the UK on the right-hand side. You know the story about the crisis, how output fell very significantly relative to past trends at that point, and also that the recovery has been very slow. Canada is the good case. We are, let's do a bit for the Canada Club here. If you look on the right-hand side, you can see the blue line there, evolving broadly in line with that fairly random trend line I've stuck on. But for everyone else, it is a different matter, and it's particularly a different matter for the euro area and for the UK, where there frankly hasn't been much of a recovery. That's the grim reality of an industrialized world where there's too much debt and where there's a big requirement for economic rebalancing of all sorts of kinds, from the public to the private sector, from domestic to foreign demand, but also a very large requirement for structural change. The policy challenge for macro policy in that kind of world is to underpin activity to the extent that's possible, to avoid deflation, but also to generally support that rebalancing effort that I've sort of glossed over the specific content of. So in balance sheet terms and stock terms, you want to have a gradual rather than a very abrupt adjustment of these problems. Different countries are at different stages. The US is clearly further ahead than Europe in terms of the financial sector and private sector rebalancing. But, well, you can't really say they have made all that much progress in terms of addressing the underlying structural fiscal issues. In some European countries, including the UK, there's a very long way to go before you can say that the household sector has rebalanced, has repaid sufficient debt to call that a sustainable level. And there's certainly a long way to go before we can say consolidation of government budgets is anywhere near completion. So as I said, policy response, the policy challenge is underpin activity, avoid deflation, and support rebalancing. The policy response, I could tell you a long story about how different it is, but actually I think some key characteristics are the same. It's tight fiscal policy and loose monetary policy, where monetary policy cover a wide range of sins. Mervyn King, current governor of the bank, called that the textbook response. And the UK, in many ways, is the most obvious example of that particular approach, even if it isn't necessarily working that well. The US tried out first to do tight fiscal, loose money without the tight fiscal. But they're coming round to it, and we will get tighter fiscal policy in the US, independent of the debate on the current fiscal issues. Europe tried a different variant. They had lots of tight fiscal, but not very loose monetary policy, in part because the transmission mechanism isn't working. That is being addressed. So in a sense, in a policy sense, we're all moving in the same direction. So let me turn to my favorite topic, central banks. So central bank part of the job here has been to ease policy as much as possible to support that process of deleveraging. Central banks have, in every sense of the word, intervened on a very large scale. Here on this chart, I've focused on the size of the balance sheet relative to GDP. And you look at the Eurosystem's balance sheet, and before the contraction started, this only goes up to Q3, but before the contraction of the balance sheet started, they were well over 30% of GDP. That's a pretty big balance sheet. But the the expansionary policy obviously goes way beyond that, in form of commitment to holding rates low for long, thresholds for tightening policy, and all that stuff that is currently being thrown into the monetary policy pot. The intended effect of that kind of policy is to hold rates low across the credit spectrum, across maturities, and basically enable the highly indebted governments, the highly indebted households to sustain the burden. And in many ways, it has been a tremendously successful policy. Nominal interest rates are low, and most importantly, they have managed to do these extraordinary measures and still keep inflation expectations stable. I think stable inflation expectation is the best measure, or the easiest measure I can think of for central bank credibility. And if you can't keep inflation expectations stable, then all the rest of it doesn't really matter. For those of you who have followed the UK debate, you would have seen the interview yesterday with Adair Turner suggesting that a little bit of monetary financing wasn't that bad for you. I think that's a quite bad idea. And the reason is if you start going down that route, if you enable governments to finance some of their spending with money, how are you ever going to make your citizens believe that they aren't going to carry on for just a little bit longer? Even if they are very disciplined, and I think the British government is very disciplined, it is very easy for agents in that context to say, hang on, if they can finance activity with that, why should I ever believe in price stability? Why should I ever believe that inflation isn't going to go through the roof? And if you first get there, then it's game over and central banks are lost. That would be the point at which central banks were truly maxed out. But as Carney says, and he's Canadian, so he's right, we're not there yet. Central banks can do a lot. The ECB has provided us a salutary lesson in what can be done. They provided a lot of liquidity. They promised to buy bonds of struggling governments. A much more aggressive stance by the ECB has been, I think, the key story over the last year. And I think looking ahead is also the key story, both in a European, but also in a global context. I put up a chart here that many of you will be familiar with. These are spreads of 5-year Spanish and Italian interest rates over German rates. So you will see the evolution up till about December 2011, where these spreads were increasing. The introduction of the long-term liquidity operations at the ECB had the effect of pushing these yields down as people became more and more convinced that no solvent European bank was going to go belly up. At some point, people realized, the market realized that that wasn't enough to underpin the sovereigns, that alone wouldn't break the vicious circle that has characterized the European financial and fiscal system for the last few years, and yields increased. The ECB's promise to buy government bonds of struggling European governments, if they behave and ask nicely, obviously has had a very pronounced effect on yields. And as I said, it's not just about what has happened in that period, that compression in spread, that very significant increase in the price of risky assets. It is the fact that the downside risk, the risk of a significant financial blow-up of our sovereign crisis spinning out of control has been severely curtailed by their action. Now, why can the ECB do this and why didn't they do it before? I think it's important here to acknowledge that for the ECB to be able to do this, you need a credible counterpart, a credible fiscal counterpart. And the progress on the political front we've had in Europe over the last year, I think, has been absolutely essential for that. You may despair at the pace at which European governments have made progress, but I think nonetheless very significant progress on the banking and fiscal union. Again, we can question whether it's done the right way, the institutional features correct, but in this context and for my talk, the important point is that has been enough to convince the ECB that they can step up and start acting like the other central banks. So that's good. What more can they do? Well, I think they have been very instrumental in preventing a balance of payment crisis in Europe spinning out of control. As I said, they've supported solvent banks in the European banking system, acted as intermediaries at a point at which the banks had lost confidence in each other. I could give you a long and learned discussion about this chart, and particularly about the target 2 balances. That's the yellow lines on these 2 charts. But it gets very boring very quickly. And actually, you can illustrate the point quite simply. If you look at the right-hand chart, you can see in the dark blue line how Spanish banks have taken a lot of money, borrowed a lot of money in the ECB through the LTRO and the regular liquidity operations, the MROs. You can see how that increased in the course of 2012. And they used the money they got out there to settle maturing debt with the banking system in the core of Europe. And here I've taken Germany, and that's a pretty good summary of the core of Europe. And you can see how they, having received that money, deposited them with the ECB. That's the light blue line on the left-hand side chart. So that process, I mean, I'm not telling you that's good news, but the fact that the ECB has been able to act as an intermediary in that way has been crucial for containing the crisis. And in the course of the last few months, as many of you will know, we have seen some steadying of those flows, and therefore the extent to which Spanish banks and other banks in the periphery of the euro area have needed to resort to that kind of liquidity has started to decline. So I've talked about things that were good about the ECB and things they've done well, and I think ECB can do more. They can still learn from other central banks. So far, what they've done is mostly provided liquidity against assets, effectively lending money out. You can see that in the two blue bars I put on the left-hand chart here, which is the balance sheet, the asset side of the balance sheet of the ECB. So they are basically the size, the assets that the ECB hold as security for the liquidity, for the money they have lent out to European banks. And you can see how that really increased very significantly. And the dark blue bar, the LTRO, increased significantly. That has been drifting down, as you know, because some of the LTRO money have been repaid. Still a very big chunk. Compare and contrast with the Bank of England's balance sheet. Actually, if you ignore the colors a bit, it's got a very similar contour because the Bank of England and the ECB went through much of the same experience in terms of the banking crisis at the first stage of the banking crisis and the economic crisis. But what is, of course, characteristic is that there's not a lot of liquidity provision. There's not a lot of lending going on at the Bank of England. There's been lots of asset purchases going on. So the Bank of England has ended up with a lot of gilts on its balance sheet, and that's what's that faint blue color we have on the right-hand side chart. The bank has done that. If we had a look at the Fed's balance sheet, it's a little more complicated, but not an awful lot more. There's a lot of outright purchases. The ECB can do that, and a central bank that's confident that it has a credible fiscal counterpart can do that kind of thing and still maintain stable inflation expectations. So the ECB, in my books, could easily do an outright asset purchase program if they fancy it. And I think talking to senior staff at the ECB, listening to what Draghi says, listening to what they say in public, again, there's a very significant change in the mindset at the ECB. 2 years ago, this kind of asset purchase program was poo-pooed, and definitely not something they would have done. I think we are now in a position that, should it prove necessary, if the macroeconomic situation in Europe doesn't turn out very well, if Germany experiences an outright recession, then this is something that could be done. So as I said, not just OMTs, but an outright asset purchase program. The ECB could go and buy German government bonds if that was necessary. So lots can be done by the central banks, and they can get very big balance sheets. But there are also things that you can't really do if you're a central bank. You can't really fundamentally solve the macro challenges and the structural challenges that you are facing in Europe. Most immediately, the monetary transmission mechanism in Europe isn't working very well. Policy isn't translating into substantially lower interest rates, and it's not translating into higher credit growth that could support consumption or investment in the euro area. That means very weak domestic demand in the euro area, and particularly in the periphery countries. So my forecast for this year has not got very much growth in the euro area at all. It has a distribution with relatively stronger growth in Germany and much weaker growth in Italy and Spain. We have a contraction for the first half of this year. But even in Germany, the relatively stronger part of the euro area, we still have a very modest growth forecast this year. And the recovery is very slow because of these adjustment processes that are happening in Europe. So if it all goes horribly wrong and Germany contracts, then as I said, I think it's possible for the ECB to do more and ECB to expand the size of its balance sheet. If it all goes horribly well, then the ECB will keep an expansionary policy for a long time. So the macro outlook is not terribly good. The ECB can't do much about that. But actually, although the macroeconomic policy strategy pursued in Europe isn't entirely sensible, it is in some sense working. I think a sensible macro strategy for Europe would focus on rebalancing of demand while you're doing structural changes in the periphery. So you would try and encourage those who had fiscal space, who had a corporate and a household sector that were in financial surplus, that is essentially the Germans, encourage them to save less, spend more, live a little, get on with it. They're not well, they haven't seemed to be very good at it. And I think part of that is actually because the German banking system has been poor at supporting that kind of credit growth. But it's also, I think, also important that Germany has just been going through the kind of structural adjustment processes that Europe is now experiencing. But they are happening, and that's the important thing. So despite what I just said, rebalancing would be better. What they're doing in Europe is a demand contraction as a means of reducing imbalances, and it is working. You look at the current account deficits, and current account deficits are a measure of the savings investment imbalance, are a measure of the pace of accumulation of debt. And you see how those, on the left-hand side, you can see how the deficits in the periphery countries have shrunk very sharply. The sensible way would have been for the German surplus to go down. That hasn't happened because the adjustment is coming around through this contraction in domestic demand. But it is happening. That contraction in domestic demand, the much higher unemployment rates, are also translating into improvements in productivity and improvements in competitiveness. I put on nominal unit labor cost here within the euro area. That's a sensible measure because the exchange rate within the euro area obviously doesn't matter. So just looking at nominal unit labor cost is sensible. And you can see how, look at Spain and Ireland, how their nominal unit labor costs were growing much faster than in Germany in the period running up to the crisis, and subsequently have adjusted very sharply. Now, I'd like to tell you that that's because of labor market reform, and one day it will be because of labor market reform. But right now, it is because of a contraction in demand and much higher unemployment that this adjustment is happening. Again, I'm not passing a value judgment. That would be the way I would do it, but it is kind of working. So let me finish off on that note. Adjustment is happening in Europe. Central banks have done and can do more, much more than their mother thought they could, and they can certainly do a lot to address some of the challenges we currently face. I haven't talked much about what happens the day they have to unwind all this. That'll be the topic for next year's discussion, which I think is a very important and interesting issue. Ultimately, your credibility, the credibility of the central bank rests on being able to do that. Macro outlook remains difficult. I think the euro area is achieving real adjustment the hard way, but it is happening. That's it for me. Over to Anil, please.